All right, we're diving straight into Chapter 5 of the book Trading Volatility to unpack a really fascinating corner of the financial world, light exotics. If you've ever wondered how traders build these super specific, custom bets that go way beyond your standard calls and puts, well, you're in the right place. Let's get into it.
So you're probably familiar with the regular option, right? A call or a put. It's a pretty simple bet on where something's headed. But what if you could add conditions? What if you could say, hey, this option only pays out if the stock price hits this level first? Or maybe, this option is completely worthless if the price drops to this other level. That right there is the magic behind exotic options. They let you turn these simple bets into these really structured conditional plays.
So here's the game plan for our little tour today. First, we'll get a nice clear definition of what light exotics even are. Then, we're going to explore 3 of the most popular types: barrier options, worst of and best of options, and then outperformance options. And to wrap it all up, we'll zoom out and talk about why any of this actually matters in the real world.
Okay, let's start at the beginning. It's really important to get this up front. These aren't the kind of things you're going to find in your average retail brokerage account. Light exotics are sophisticated, custom tools mainly for advanced investors and big institutions who need to build really specific trading or hedging strategies.
So, what are they really? Honestly, think of them as options 2.0. They take a standard or vanilla option and just start layering on more complexity. So instead of just having a strike price and an expiration date, they start introducing all these new rules and conditions. And the goal here? It's all about creating these totally custom risk and reward profiles that you just can't buy off the shelf.
Our first stop is going to be barrier options, and according to our source material, these are hands down the most popular type of light exotic out there, and for good reason too. They're often the fundamental building blocks for a whole bunch of other complex financial products.
It's kind of all in the name. A barrier option has a trigger point, a price level that we call the barrier, and the entire fate of the option, whether it pays out or not, depends on if the asset's price ever touches or crosses that line. You can almost think of it like an option with a built-in on-off switch.
And these barrier options, they come in 2 main flavors. You've got a knock-in option. This one starts out dead. It does absolutely nothing until the price hits that barrier. Then boom, it springs to life and becomes a totally normal option. On the flip side, you have a knockout. This one starts out as a regular option, but if the price ever touches its barrier, poof, it's gone, becomes completely worthless.
So you might be wondering, why all the extra complexity? Well, at the end of the day, it really comes down to cost. A knockout option has that built-in self-destruct button, right? And that makes it cheaper than a regular option. So imagine you want to protect your stock portfolio from a crash, but regular insurance is just too expensive. You could buy a knockout put that only protects you unless the market rallies, say 10% first. If the market goes up, yeah, your protection vanishes, but you paid a lot less for it. And that's the trade-off.
All right, let's switch gears. We're moving from options on a single stock to options on a whole group of them. These are called worst of and best of options. And this is where a fascinating new ingredient gets thrown into the mix: correlation.
The idea here is actually pretty simple to grasp. You take a basket of assets. It could be, 3 different tech stocks or even totally different things. And the options payout isn't based on how the group does on average. No, it's tied to the performance of just one of them, either the absolute best performer or the absolute worst.
This table lays it all out really nicely. Just look at the cost. A worst of put is expensive. Why? Because the odds of at least one stock in a basket falling are just way higher than any single one of them falling. This makes it a really attractive thing for investors to sell to collect that premium. But a worst of call, on the other hand, is cheap because you only get paid if the worst performer actually rallies. So that's a popular way for buyers to get some cheap exposure to the upside. And the key thing that drives the price for all of these is the correlation between the assets in that basket.
Now, what if you want to trade relative value? Let's say you don't really care if the market goes up or down, but you are absolutely convinced that one asset is going to do better than another. Well, that's exactly what outperformance options are built for.
Yeah, this is a pure relative value play. So instead of betting on stock A going up, you're betting on the spread, the difference between stock A's return and stock B's return. I mean, you could believe both stocks are going to fall, but as long as A falls less than B, this option could still pay out. It's a really powerful tool for isolating a very specific view.
So how are these things priced? Well, the key, again, is correlation. Traders would call these short correlation. Let's just break that down for a second. If 2 stocks almost always move together, they have high correlation, the chance of one of them dramatically outperforming the other is pretty low, wouldn't you say? so the option is cheaper. But if they tend to move independently, there's a much higher chance of a big gap in their performance, and that makes the option more expensive. Makes sense, right?
According to the source, the main people using these are hedge funds. And why do they love them so much? Well, there are two big reasons. First, like we just said, if the two assets are highly correlated, this option can be way cheaper than buying a regular option on either one. And second, it perfectly defines your risk. The absolute most you can ever lose is the premium you paid to get in. That makes it a fantastic way to structure a relative value trade.
Okay, for our last section, let's pull the camera back. We've seen a few specific examples, but what's the big picture here? I mean, why does the financial world even need these complicated, engineered products?
You know, what we've covered today is really just the tip of the iceberg. The book mentions tons of others, like look-back options, where the strike price is actually set retroactively at the best price the asset hit over a certain period. Wild. Or contingent premium options, where you pay nothing up front. And even options designed to handle trades across different currencies. The creativity is almost endless.
So here's the crucial takeaway. Light exotics exist to solve very specific problems. They let investors build these incredibly precise risk profiles that you just can't get with vanilla options. They can lower the cost of hedging or taking a position. They open up this whole world of complex trades based on relative value or correlation. And, as we've seen, they are the fundamental Lego bricks used to build so many of the structured products that are out there in the market today.
At the end of the day, these instruments really show that finance isn't just about simple up or down bets. It's a field with immense creativity and engineering behind it. And it kind of makes you wonder, if you could design an option with any rules you wanted to perfectly express some unique view you have on the market, what would that custom bet look like? It's something to think about. Thanks for joining me on this tour.